Welcome to Make Your Wealth Work, the podcast where wealth becomes your greatest ally in achieving your dreams.
Man, there is no question at all that if you're listening to this show, you want to know how to get started with infinite banking. And that's what we're going to talk about. We set the foundation in the last two shows, and today we're going to get down to brass tacks. Are you ready, Mr. Pantozzi?
I'm ready.
So, brother, lay it out for us. For someone who is interested in infinite banking, what would you say are the first steps they should take to get started?
Well, call us.
Obviously. That's why we're doing this.
Get together. Let's have a conversation about where you're at. Let's find out if you already have some of the component pieces, because one thing that people miss is that you can start on this path and start practicing infinite banking and using the model with existing permanent life insurance policies that you have. If they're whole life policies, we can work with them. Doesn't matter what kind of whole life policies they are. It doesn't matter what kind of cash value policies they are. We could talk about the negatives on universal, index universal, variable life. But if those things have cash value, they can be used, and I'll have to put an asterisk after that because they need to be managed very carefully. That's a sidebar that we could talk about another time. But if you have existing policies, you already have a capital base that you have begun. And probably what you need to do is start getting serious about building that capital base. Now, here's an example, which is, again, based on my experience. When I first met Nelson Nash, he asked me what was the most important asset or the biggest asset in my world. And I said, well, that'd be me. It's my earning ability, my income ability. And he said, so are you putting more money into your life insurance, or are you putting more money into your mortgage payment? And I said, oh, ouch. At that time, which was the year 2000, my mortgage payment was higher than my monthly life insurance premiums. And I wish I could just duplicate that beautiful Birmingham, Alabama accent. Well, son, don't you think we need to fix that? Yeah. And today, my life insurance premiums are a very strong multiple. They're not 2 or 3 times my mortgage payment. They're a very strong multiple of my mortgage payments. And I've been building that asset base now for over 20 years, right? So we're talking about getting started. You can get started with what you have. We can coach you with what you have because most likely you haven't accessed it because maybe you haven't understood that you already have the privileges and the rights of ownership with the policies you have today. And I can point those privileges out to you in your own policy. So let's not overlook the possibility that you've already got some assets that we can take a look at. I could give you lots of examples. I have a client who had a very expensive car loan, and come to realize she had more than enough cash value in her life insurance policy. She hadn't put the 2 and 2 together.
Wow.
When we took a loan against her life insurance and paid off her car payment, we saved her in her particular situation over $400 a month.
Wow.
In car payment. Now, am I comparing apples to apples? Absolutely not. Because the first thing I did is I needed to help her get some breathing room because she was underwater. She was paying out more than she was taking in. The first thing we need to do is give you some relief and give you some breathing room in the short term. Now, you're going to have to pay the loan back if you want to have that money accessible again, so you can borrow against it again and maybe borrow something that is going to create capital base and create cash flow. But getting started, let's start with what you have. Now, item number 2 is when we get together, I'm going to strongly encourage you to read the book because I want you to understand the truths that have formed the foundation of infinite banking. This is
Joe,
not.
give us the title of the book. You can't just say read the book and
I'm
just keep going.
sorry. Yeah. It's Nelson Nash's book, R. Nelson Nash, Becoming Your Own Banker, subtitle, The Infinite Banking Concept,
There we go.
published in 2000.
That's the one.
So once
Right.
I met Nelson and I got the book, that book sat on the side of my desk and probably found its way to the bottom of a pile for over a year. And a couple of my friends, God bless them, continued to nag me and harass me and encourage me to read that book. And once I read it once and twice and three times and had the privilege of being in Nelson Nash's company during his 10-hour seminar and started to get this embedded into my psyche, I realized that I was personally doing banking the wrong way and I was teaching finances the wrong way.
Wow.
And so we started to encourage people to take policies, to make a part of their model, and of course, build the policies the right way, because there's a right way and the wrong way. I bought whole life policies the wrong way the first 24 years. I like the way my career overlaps very neatly. I had 24 years in the last century and 24 years in this century. So I've been doing it the right way for the first 24 years. But again, it's important to understand those policies that I funded in the first 24 years still wound up being IBC policies because they're just full of cash. So maybe they weren't funded properly initially and they were slower getting started. But guess what a policy looks like after you've been paying on it for 20 years? It looks really great.
That's where the magic happens. So let's talk a little bit about that, because we have talked about if you might have some of those existing policies in your portfolio and you may be able to use them, but let's say you don't have a policy yet. What should our listeners be looking for in a whole life policy if they want to do the infinite banking concept?
So we are very purist about the policies that we use. We use a properly structured dividend-paying whole life policy. Now, there are different variations of whole life. I mean, you could look at a 10-payment life insurance policy. You could look at a single payment. You could look at a life paid up at 65 and so forth and so on. But for us, it's a properly structured dividend-paying whole life policy from a mutual company, right? And we work with only mutual companies because we believe that the profits, if you want to call them that, and we'll just call them that for now, the profits of the performance of those companies belongs to the policyholders. And when you take the other companies, the publicly owned companies called stock companies, what they're doing is they're paying out their performance dividends to shareholders. So you could own shares in a company without owning a policy. And so the way I look at it, those shareholders are taking away values from the company that should rightfully belong to the policyholders, who are the only owners of a mutual company. So I'm receiving dividends on my policies because I am considered one of the owners of the insurance company. Now it's a small share, right? It's a fractional share because there are millions of policyholders, but we all get the benefits of that company continuing to stay in the black, continuing to pay on its claims, continuing to build reserves, continuing to invest its money conservatively. And there's just a super key point that we just cannot emphasize enough. These companies don't lose the money. I was just on the phone with the chief actuary with one of our primary companies the other day. And this is really important that whole life issued by dividend paying mutual companies is different than other financial products that may be called securities, in that a whole life policy is backed up a dollar for a dollar. So if we have $1 of liability, the insurance company has $1 or more of assets. Now, People aren't used to that because most people don't even understand
Fractional
how banks
banking.
work. Right.
Yeah, right.
Right. And so in this country, there used to be a law or rule that said banks had to have a certain amount of reserve or margin in order to back up their liabilities. Well, that reserve requirement was removed by the Federal Reserve in 2020, just 4 years ago. Guess what? During COVID. So you could literally have a bank like Silicon Valley Bank in California that went under a year and a half, 2 years ago with $200 billion worth of liabilities without $200 billion worth of assets. See, with a mutual life insurance company, that cannot happen. Now, sometimes people may think, well, this is a whole bunch of technical jargon. You know what? If your company goes under, if your bank goes under, it's not going to be a bunch of technical jargon. You're going to worry. And then you're going to come back and say, well, wait a minute. I have FDIC. Okay, let's look at FDIC for a second. FDIC has about 1.5% of the reserves that it should have. 1.5%. What does that mean? If enough banks go under, the federal government may come in, might come in, will come in, and take money out of another bucket and make those savers whole. How long does that happen before it starts to make a dent in our national debt, in our tax structure, right? So even though these things may sound boring, they are eventually going to affect your personal finances if enough of these ripples happen. And that's why I like having my reserves with a mutual insurance company that literally has 100 cents on the dollar. Assets backing liabilities.
Crazy.
So for me, that's an important part of a whole life policy. And getting started is working with a professional like me, and there are others like me around the country. And I'm sure that I don't have the capacity to handle 50 million people who are interested in infinite banking, but I'm not worried because a lot of people are more interested in the things that don't matter, like immediate rate of return and other things that really don't pay the bills. But find yourself a professional, someone who's qualified, someone who's credentialed, someone who's an expert, who can show you how the policy works, and matching up the size policy to your particular situation. Now, back in the day, in the previous century, right, in the 1990s, 1980s, 1970s, people would come to me and say, I want to buy a life insurance policy. What's it going to cost me? And we would give them a rate, they'd buy a policy, and away we go. Now, since I met Nelson, the emphasis is not on life insurance and death benefit. The emphasis is on your need for finance. So if you have a need to pay off that second mortgage, if you have a need to send your kid to college 5 or 10 or 15 years from now, if you have a desire to have a second home, a house in the mountains or whatever, or take multiple vacations, make certain investments, you're going to want to have an increasing pool of money. That means you shouldn't worry so much about the life insurance amount as you should be concerned about funding the right amount of money. And so when a client says to me today, what does a policy cost? I say, we can back into that, but what really matters is your need for finance. What do you think you need to put aside in order to make your banking system work? How much would you like to have access to? See, it's today, people want to buy a policy for $19, right? But when they get to 70 years old, they want that $1 million in cash to be in some financial product that they own. So today they want cheap, but tomorrow they want the sky. So I want you to think forward, right? Begin with the end in mind. All right. Think about what it would look like, what it would feel like, what it would act like if you had $1 million in your savings account. Now let's help get you there.
That's fascinating, Joe. And I never heard anybody put it that way. Let's look at your need for finance, because they're thinking of the insurance part, But what you're explaining is the banking function, which is the real power here. So can you give us maybe top 2 or 3 mistakes you see people make when they're getting into the infinite banking concept?
Sure. Well, I go back to Nelson's rules, right? One of Nelson's rules is don't be afraid to think long term, right? Remember, he was a forester. And so people will look at this as a get rich quick scheme. Well, if I can, get rid of all my credit cards and get rid of my car loan and do all this stuff, I can wind up with a pile of money in 5 years. Well, but so what? You're not going to retire for another 20 years. We need to think about the long term. So thinking short term is a mistake. All right. Another mistake would be Nelson told us, one of his rules, don't steal the peas. Now that has to do with the grocery store example that's in the book. But if you owned a grocery store, you would have a tendency to want to take your groceries out the back door after hours and not take them to the front checkout during hours and pay for your own groceries. So Nelson is saying, don't steal the peas. And how does that translate into your policy? When you set up a life insurance policy and you have loanable value in it, and you go to negotiate a loan or take a loan, the mistake people make is not paying it back. Because they figure, well, I'm just borrowing my own money. Actually, you're not borrowing your own money. Your money continues in the policy. Your money continues growing. You're borrowing the insurance company's money. They're giving you a screaming deal because they're giving you a 5% interest-only loan for as long as you want it. But why would you want to pay it back? So that you could borrow it again. So you could build more assets, so you could build more companies, so you could do more things. You want to continue that money in motion, but you want to continue it coming back to you, not going away. So don't steal the peas. Some people think that the very act of taking a loan against the policy and paying it back is some magical way of building equity and creating velocity and compounding. It does nothing of the sort. The reason why you would take a loan against the policy is to take that money and put it into another asset, a new capital asset that's going to create wealth for you. Let's say you're going to open up a sandwich shop. You're going to open up a business of any kind. I mean, something simple, and what we try to do very early in the relationship is help you what we call recapture debt. So you got a 25% credit card out there with Visa, and you could replace it with a 5% loan through your insurance company. Right away, we're going to improve your financial situation because we're going to get rid of those credit cards. But once we get rid of them, we want them to be gone and not come back. All right. So we want you to get used to being your own banker, behaving like a banker, and looking to make a profit. Right. That includes making a profit on our own processes, our own investments, our own cash flows. Now, I lent my daughter money to buy a car when she was 20 years old. Okay. I'm such a mean dad. I required that she pay it back. She actually paid it back at higher than market rates. Why? Because the other variable was she wanted to control her monthly payment. I said, well, I can help you control the monthly payment. It's going to take a longer schedule and a slightly higher rate because not only are you paying back into the bank of dad, there might be a slight possibility that you might inherit one day from the bank of dad. And you're probably not going to inherit from Nevada State Bank, which was our bank at the time. So do you think you have a better possibility of inheriting from Nevada Bank or from Bank of Dad? And if that's the case, then when you repay your loan, you're actually increasing your inheritance down the road. And really, let's look at it from a very cold and calculating standpoint. What if I get really sick in the future and I need additional resources to help me live in my older years? Well, you just help me increase my resources, and we won't get into chronic benefits, critical benefits, terminal benefits that are all part of a policy. So when she signed up for that car loan, she created a whole slew of benefits, not only for herself, but also for her future legacy.
That's incredible, man. So today we covered what are the first steps to begin with infinite banking, how to choose the right policy, and we covered some common mistakes, including thinking short term and not paying yourself back. And I know that you could keep going forever, but we got to put a pin in it. Now, next time Joe's been teasing this, Joe's been talking about this, taking loans and becoming your own bank. This is the core benefit. This is what you guys have been waiting for, and that is coming up in the next episode. Anything you want to say as we're wrapping up, Joe?
Yeah, I almost forgot to talk about thinking too small.
Oh, thinking too small.
I kind of alluded to it when I said people want to pay $19, but they want to have $1 million at the other end. So thinking too small would involve starting out with too small a number.
Yeah.
And this isn't about me, because when we started designing policies the right way, our commissions went down by 40% in terms of a rate of commission, because everyone on the planet lives on commission, by the way. But our business exploded and quintupled 500x because people were designing their policies based on their needs for finance, not insurance. So a mistake would be thinking too small and starting out too small.
Man, that concept, man, that's a huge one. Like, that is the bombshell in this episode. And guess what? We have more coming next time. Thank you guys for tuning in. That is a wrap for another episode of Make Your Wealth Work.
This is thepodcastfactory.com.